Dan, this is relevant because people are trying to figure out how far this rally can go. I mean, cutting rates to, minus 3% would suggest maybe a lot further. I mean, at least for the time being, and then we just have the consequences to live with for some time, right?
Yeah, I think that, what we're looking at, Kelly, is it's something that's generally considered, negative, obviously, from the standpoint of the overall economy, that, you're really in a position to where you're almost in desperation, and you're at a level now that's so low that, frankly, the difference between 0 and 25 on Fed funds and then going to 0 or a slight negative is not going to be something that's going to be, highly motivating to corporate executives to borrow additional money. And it creates a lot of problems in the financial markets, especially with regards to money market funds, their pricing. I think that President Trump wants to show that he's willing to really do anything, and all possible ammunition is available. But it's not really something that I think is going to move the needle at this point as we go forward, and causes some significant additional problems. We have a lot of other things that we need to look forward to, and that's why you're not seeing much reaction overall in the bond market.
Yeah.
The bond market, has been pretty stable.
Well, and it's not so much the president's support that I find noteworthy as the fact that more people on Wall Street seem to be warming up to the idea and saying maybe this is something that could happen, maybe even something that should happen. Dan, I know you always come with some specific stock ideas, and today Bank of America is on that list. Would you want to invest in Bank of America or any other bank in this country if you knew negative rates were coming?
Well, I mean, obviously, if you go to negative rates, it adversely affects their net interest margin and is going to squeeze them to some degree. But I think that, why a Bank of America, and a number of others are very, very attractive here is just really their valuations. I mean, you look at a Bank of America, it's trading at an 8 PE. You really look forward at where the earnings are going to go. I mean, everybody's a little late to the PPP program, but they were actually out in front more than most. They're going to make 5% at no risk on billions of dollars of loans. All of these large corporations have tapped into their credit facilities, and so their loan portfolio has dramatically expanded. And though they're going to get hit for 2 or 3 quarters on putting in new loan loss reserves, this is not like 08, 09. I mean, it's not going to be a 6 to 8 quarter increase of loan loss reserves. It's going to be 2 or 3, and then they're going to start to book these earnings into the latter part of 2021, and profits are going to rise for these companies, and they're very low valuations now.
Yeah. Michael, stay right there. I'm going to turn to you. I just want to bring in Rick Santelli. We just had the results of the 10-year bond auction, which just came in, 10-year Treasury notes, I should say. Rick Santelli, what can you tell us? How'd it go off?
It was a barn burner. This was a really good auction. So let's go through it quickly. $32 billion of fresh 10-years. This is not a reopening. The yield at the auction, 0.70. Lower yield, higher price. This is below where the when issued market was trading at straight up 1 Eastern. And all the internals are solid. 2.69 bid to cover, the best since mid-2016. 66.1 on indirects, best since April of 19. 13.3 on directs is just shy of the 10 auction average. Dealers take 20.5. That is really a small amount compared to 27% 10 auction average. So no matter how you slice this one, a really solid auction on the long maturity, unlike yesterday's 3-year. Tomorrow's 30-year, I suspect, will be somewhat similar, and that'll be $22 billion. And by the way, this is the lowest yield ever at an auction for 10s, and it's the biggest size 10-year auction ever as well, Kelly. Back to you.
So it's the lowest yield ever, the most ever auctioned, and yet there was so much demand, you give it an A.
A for Apple. It was a solid auction.
Wow. Rick, thanks. We appreciate it. Rick Santelli there. Let me turn back to Michael Cuggino, talk a little bit about the implications for this market. Michael, and the fact that we're talking about negative rates maybe plays into this. What's your reaction to what's going on in the bond market, what that's telling us these days?
Yeah, Kelly, I mean, the fact that the auction was so robust says there's a lot of demand for 10-year treasuries at 70 basis points. I don't find that really an attractive investment profile risk-reward, but that's where investor heads are at, and that's why we're talking about negative yields. I mean, I think at this point we're largely near negative yields. I think it's more of a psychological thing than anything else if we dip much further. But, the 10-year, the 30-year, you're looking at negative real returns after inflation and the risk-reward right there. I mean, I think you want to own bonds as a diversifier in case we have a redo of the shutdown, in case economics don't recover as fast as we want. But those would be the only reasons, pure defensive, because I think you can do better than that with a diversified portfolio or even in an equity portfolio alone and ride out the the wide swings. So
Yeah.
I don't find it real attractive at this point, even though it was a robust auction.
You know, Michael, that's obviously on kind of the government bond side. What about corporate bonds as the Fed starts buying today? Spreads there are still, wider than normal. Would you be buying into those investment grade, maybe even those junk bonds right alongside the Fed?
Yeah, for us, it's a little bit more attractive because, the Fed subsidy is significant. And I think when you start getting into corporates, we focus on investment grade and relatively short duration. And there it gets to be company specific and industry specific where you can go low on the duration and you go high quality balance sheets. The risk of default is lower and the likelihood of better yields, marginally better yields, but at least better yields than what you're getting in treasuries with decent credit quality is better. So if again,
Michael, you just dropped out there. Let me, Dan, ask you the final question then before we go. And I do want to circle back to the point about banks. And as you said, Bank of America is trading at 8 times earnings, which is incredibly low by historical standards. But if you look at the performance of banks in Japan and Europe, if we are going that way, those bank valuations have lost, in some cases, 80 to 90% of their value over the last decade. And what happens if we're following the path that they've already laid out here? Negative rates, massive expansion of the Fed's balance sheet and so forth.
Well, I think you're just dealing with a different situation now, Kelly, and I think that the market is looking at the banks and they're looking back and they're painting it with a brush that was similar to 08 and 09. And they're going in with much higher loan loss reserves now. They're going in a stronger position. I think the real question is going to be what's going to happen to loan creation. And that's the unknown, and they're being punished for that. But as I mentioned, the activity with the support of the Fed programs, what they're having in credit lines, people that are clearly going to borrow to try to re-accelerate their growth. I think when you look at the numbers at these valuations, it's not that they're necessarily going to be the strongest performing group, but to say you can go from an 8 or 9 multiple back to a 10 or 11 and still be at a huge discount to the market, I mean, that's a 20% move in share prices, and I think that's very reasonable.
All right, Dan Genter, thank you, sir. Michael Cuggino, we thank you as well for joining us with your thoughts on the market today.